Well, welcome back, ladies and gentlemen. We are going to get straight back into things now, and we're going to hear from the head of research at Patterson's Securities. Patterson's are gold sponsors of the event, and they're very supportive of the one-to-one conferences around the world. So thank you very much to Patterson's. If you haven't had a chance to meet with Patterson's, please do go and see the team. They've got a stand up at the top there in the coffee room, so please do go and see them. But now we're going to hear from Cathy Moises. As I said, she's their head of research, and she's going to be talking about the Australian mining equities market and talking about it moving back into a supportive mining market, which sounds very positive. So, Cathy, take it away.
Thanks, Leo. Well, my topic is moving back into a supportive resources market, and I think everyone at this conference will agree that it's a breath of fresh air to actually have stocks rising and renewed interest in the exploration and development scene globally and specifically for us in Australia. Patterson's have been very proud to be a supporter of this conference for quite some time now, and we have a booth up near the lunch area, and we have Alex Rivera and Mark Tomlinson from our corporate department, and myself, who's head of research, also up there if anyone would like to have a chat with us after this. The topics I'm going to run through in this brief presentation are why Patterson's, key themes in the resources sector, a commodity price check, which I'm happy to say is looking very healthy indeed, 17-18 success stories to date, a price outlook for key commodities we have under coverage, equity market update, and finally an outlook for the balance of 2018. Why Patterson's? We're large. We have 14 billion assets under management, and of that about 3 billion is actually in the resources space, so very much resource-centric. We have 11 offices throughout Australia with over 60,000 clients with funds under management with us. We're Australia's largest active arranger of equity capital for the resources sector. We have a very experienced in-house research team, and we have strong institutional relationships. We have a very large research department. We've been building that. I've been with Patterson's just a year, but I've got 30 years experience in the resources sector, starting at Macintosh Merrill's, going on to County City, and more recently with Evans and Partners. So a lot of experience in the space. I've got 30 years. Simon Tonkin, who does base metals for us, and bulks, has got 19 years. Xavier looks at the exploration space, and he's got 12 years, and Cam, who looks at lithium, graphite and energy, has 10 years. So combined experience within the team of over 150 years, so very experienced team. We currently have 88 stocks under coverage and 43 within the resources sector, and that's growing. Key themes of the resource market at the moment. I think we'll all agree, and it's an exciting time to be in resources. With the resurgence of interest in the EV sector, we've seen all sorts of interesting commodities like lithium and cobalt suddenly come into focus, and we've seen some phenomenal stock performances in those sectors in the last year or two. The Chinese economy continues to grow, and Australia with it. The US economy is improving. We've seen tax cuts, infrastructure spend, and really we're starting to see the stage very well set for a renewed resurgence in the broader resources sector. Green economy has been a major theme across globally, with battery technology, e-vehicles, and concerns that there really won't be anywhere near enough supply of the key commodities to drive this sector in the future. Over the last 5 years, we've really seen a contraction in exploration and development spend, and that's flowing through to very few discoveries over the recent times. And we're hoping that's going to reverse as we're seeing increased investment in the sector, profitable mines, and a renewed exploration spend across the sector. We're seeing opening of funding. Let's use it wisely. I think this chart tells it all for Australia, and it certainly made my life a lot easier. 25% performance year to date versus pretty well flat-lying in the small resources versus flat-lying for the All Ords. So we've outperformed. And we're seeing generalists start to refocus in on the resources sector. And I think the fact that we're seeing some very disciplined management decisions is increasing the confidence that we're actually going to see some continued performance within the broader market. this chart really shows sort of the way the stage has been and where it is at the moment. We really are coming off lows in terms of exploration spend, and that's really flowed through to minimal discoveries. But over the last few half-yearlies, we have seen a rise, and we've seen a 43% over the last 5, and we're hoping that's going to extend on in the future and really start to see renewed vigour within the sector. This shows the capital spend over the last while, and you've really seen the equity and capital markets was closed for quite a while, and that's resulted in a lot of projects being mothballed, and we're just starting to see it opening up, and we're seeing quite a few. I mean, going around this conference and also having just done the London and Hong Kong 121 conferences, we are seeing a lot of advanced development projects now funded, and it's going to be really interesting seeing how those projects perform over the next couple of years. Commodity price check. Surprise, surprise, cobalt is leading the ranks. But we're also seeing really strong performances from nickel and lithium, and conventional bulks are definitely lagging the EV market in terms of performance. But I think that strong performance, talking to a lot of the guys at the conferences, the price assumptions in most of the forecasts at the moment are well below the prices which we're enjoying at the moment. So I think that's also setting the stage for some good upgrades as the projects start to factor in these higher long-term prices. But also I'd say, as an analyst who's covered the sector for a long time, it's really pleasing to see conservatism in general forecasts. So yeah, I'd rather see companies priced to upgrade rather than priced to readjustment downwards, which we have certainly seen in the past. Success stories year to date. Surprise, surprise, battery metals are the feature, with Kidman and Global, the highlights of the ASX larger caps, but also a little tailings retreatment, which hopefully will be very large, in New Century Zinc, which is due to start its tailings retreatment of Century in July this year. So proof of concept is around the corner for them. And Linus Corporation, which since I set this slide has actually come off after the Malaysian elections, saw a new party elected, and it's caused some concern over Linus, but still the rare earth sector is alive and bubbling, and Linus is the lead supplier in the free market outside China, so I certainly rate Linus very highly. BlueScope's also in the top, and then when we look at the smallers, lithium and manganese feature. But look, the numbers we've got out of this sector over the last 12 months, you know, 1,000% increase, 600%. I wouldn't expect to enjoy that across the sector wide, but it's clear that if you look at the resource sector at the right time, the gains are phenomenal. And I think if you're very selective in what you select, you can certainly still make a very good earn, even though the prices have increased already. The green economy is certainly, having covered the sector for a long period of time, it's quite a new phenomenon to me. I'm used to covering gold and base metals, and suddenly there's all these new weird and wonderful commodities in the scene. But it's really interesting having a look at the strategy on China, looking to reduce pollution, and certainly covering rare earths myself. That's really flowed through to an increased emphasis and concern that Linus is the key supplier to the free market. Will there be enough Linuses around in 5 years' time when the EV market really kicks in to actually supply? I think not, so it's an area we need to continue to focus in on. There is a global push to grow green, and again, having been around the world with all these conferences looking at the pollution around a lot of these developed cities, I can certainly see why we're looking to go greener. And certainly lithium, nickel, cobalt, manganese, copper and rare earths, well, not lesser extent rare earths are featuring at these conferences as more and more people are getting on this bandwagon on the anticipation that the demand will be a lot higher than conventional materials. I'd highlight that compared to, say, the AIM market in London, the ASX really does seem to be a great hunting ground for these stories, and particularly in the lithium space, we have a number of very strong candidates for investment, and I think it's well worth having a look within the ASX sector for these commodities companies. Just a few snapshots I've taken from a few of the companies under coverage just to highlight the kind of growth we could be seeing coming in the next few years for the EV minerals. This is from Linus Corporation, just showing the increase in hybrid and plug hybrid and electric cars over the next 8 years, and it's quite stark, the amount of extra capacity we're going to need. And looking at that, clearly I'd expect some delays from the conventional forecast, but the fact is it is going to happen and it is going to continue growing beyond 2025, in my view. Basically, looking at the increase in demand for rare earths alone, it requires a new Lynas every 4 years. Where are we going to get this from? Most of the rare earth developing companies have got impediments of NdPr price, which are currently tracking around $45 a kilo, of about $70 a kilo, and you've probably got a 3 to 5 year time frame window to actually get these new projects up and running. So we're really seeing a major potential looming deficit in a few of these very capital intensive but very necessary materials for the EVs. Again, lithium obviously has been a key focus for the ASX and the broader market for a number of years. It had a brilliant run and it's come off more recently, and a couple of the major broking houses have come out and said we're going to have oversupply. Internally with Patterson's, we'd beg to differ. We'd say that if we assume that everything was going to come on time and on budget, yes, we may have oversupply, but when has that ever happened? And I saw a quite interesting chart from a presenter here, which basically said that there was massive growth forecast in 2016 and it never actually eventuated because these projects don't always get funding, and I've yet to see many projects outside the conventional gold and base metals which actually come on bang on time. So it'll be interesting to see, but that's the forecast. Are we going to get the production in? I'd say it'll be line ball. Hence, this is the lithium chart. So we've seen a really, really strong growth in lithium price over the longer period. It's come off a little bit in the more recent times, but I think the stage is very well set for lithium to continue to perform. And whilst there are alternative battery in contention, I still think this is the preferred option. And I think seeing Tesla have the agreement with, I think it was Kidman, backs that. Alternatives, I mean, we've seen a couple of really interesting vanadium plays in this conference, so there's clearly an area which there's not as much supply coming on, but certainly it's an area which I think people should start to focus in on. And also there's lower cost alternatives such as zinc air. And I think if the lithium and the NdPr prices continue to escalate over a longer period, maybe some of these alternatives will come into fore. But I think at current prices, it's more likely that the preferred option will remain the lithium-ion battery. Cobalt. Well, cobalt to me was just the lesser byproduct of the laterite nickels for many, many years, and there certainly wasn't much being produced as nickel was very much out of favour. But we're now seeing a resurgence, and there's a number of standalone cobalt plays at these conferences, and certainly going around the traps, there's certainly some very interesting stories coming around on cobalt. But it's still probably an area of concern that the amount of supply potentially coming on is nowhere near to the extent of, say, the lithium market. And I think the fact that the cobalt price has outperformed all other metals in the last little while, it backs that up, that the market is becoming very concerned that we may have a shortage of cobalt. Well, base metals, it's one of my preferred sectors. I've covered it for 20 odd years, so it's definitely much easier to have a look at. Zinc's very interesting. We've seen a major downturn in supply in the short term, and as I've previously mentioned, New Century has fast-tracked its development of its tailings to take advantage of the window in the zinc price. Zinc has traditionally been very volatile, so we're not sure whether that'll last in the longer term, but we certainly, there isn't a lot of new supply coming on, and we certainly favour the zinc market, and anything in the lowest cost quartile is always of interest to us. Copper and nickel, we expect the demand to increase as the EV story continues to develop, and certainly particularly in the copper market we struggle to find new names, and even at this conference there are very few new major copper developments I'm visiting, and I think that's an area of concern, and probably positive news for the current copper producers that maybe there really will be a shortage of supply coming on for copper. Where's the gold price headed? I think this says it all. Who knows? We tend to be fairly neutral on our gold price forecasts. We are forecasting a price range of 1,200 to 1,380. We actually use the forward curve in all our forecasts in-house. But where we feel there's upside for the ASX producers is we still feel the A dollar to US dollar is going to continue to weaken. So the A dollar producers could continue to enjoy increased Aussie dollar prices. But that being said, I cover quite a number of names on the ASX sector, and they're enjoying a great day in the sunshine. Most of the companies I look at have got all-in sustainings of between Aussie $900 to $1,200. So they've really got very good cash build. We've seen debt obliterated across the whole sector. Very few companies now trading at net debt, and the ones that have got net debt have still got generally very large lines of credit. But as I commented earlier, within the gold sector, I've seen really, really pleasing discipline in management that 10 years ago people were really looking at growth in the sector for growth space, and we saw some very marginal projects being developed, and we saw a number of major failures within the sector. Whereas the current management team seem to be focused very much on return. They're quite happy to look at lower production if the IRR justifies a lower production, and certainly looking at delivery to shareholders, which I think, whilst the gold sector really hasn't been the focus for the last few years, it has performed well over the last 6 to 12 months, and I think it will continue to come in focus as people become more comfortable that the current management teams across the sector are very much focused on shareholder return. And there's some very, very strong projects which are under development at the moment. Uranium, not a sector I cover personally, but Simon Tonkin, who's our uranium analyst, is very positive on the uranium sector. I think the key theme in uranium is most of the potential uranium producers require uranium prices very much higher than the current price. And as we're pushing back on alternative energy to reduce pollution, we feel that there has to be a renewed focus on uranium. And the fact that we're looking at significant production cuts, and we feel that uranium is trading at a low, and there's a very, very serious opportunity within the uranium sector for the brave. So we highlighted up front that we really are looking at a very interesting time in the sector. You know, we've gone through a fairly sort of extended down period, particularly from my experience in the ASX. But the secondary market, the window now appears to be open for capital raising with supportive commodity prices. We're seeing renewed increase in placements and issues, and most of the ones I'm seeing are heavily oversubscribed, which is very positive for the sector. We're seeing plenty of JV deals happening across the sector. We're still seeing a focus on consolidation for the right reasons, to really cost savings and use one mill in a hub rather than build 3 expensive mills when they really aren't necessary. And we're starting to see Canadian companies looking for Aussie projects again. So I think for us Australians, it's nice to see that people are really looking at Australia as a very safe jurisdiction for investing in, whereas we've seen a few blow-ups over recent years with Tanzania, the most recent, where they've totally renewed their mining code, and we're still waiting for the first MLs to come out. I personally think it's going to be resolved in the short term, and it will be business as usual, but it always does cause some concern for investors when this happens. We're seeing the IPO market freeing up. We saw 25 IPOs in 2017, up from 7 in 16, and certainly as an analyst, I'm seeing a rash of potential IPOs coming across my desk over the last 6 months. So I think 2018 will be even stronger for the sector. And I think we're really seeing risk appetite moving back into the smaller cap space. If I look at the gold sector in Australia, the majors are all trading at roughly 2 times MPV, which is the way we tend to value them. Now, historically, that has been the case, and so I'm quite comfortable with that. But a number of the juniors, particularly the ones come funding, are trading at very significant discounts to MPV, and going around in a pretty extensive marketing round over the last 6 weeks or so, I've been quite surprised that a number of generalists are looking to the lower cap space, like 20 to 150 million, provided that they have a serious project which will be developed, which will go up to, say, 80,000 plus ounces per annum. So we're really seeing a step change that pretty well the whole sector's acknowledging that the major gold sector is very optimally priced at the moment. I won't be rude and say overpriced. And we really need to look to the junior sector. And there's some really interesting names coming out in the junior sector which are very much investment grade. And certainly backing on from that, we're seeing a number of M&A deals happening, and certainly the likes of particularly St Barbara, Northern Star, Evolution, doing a number of JVs with the junior space in the exploration side, and also taking cornerstone investments in the junior space. So we're seeing the cashed up majors becoming very supportive of our junior market, which is another positive. In addition to the M&A space being wide open, we're also seeing an increase in deal size, with the number of deals steady. And we think that this is likely to continue to ramp up given the supportive commodity price environment. Again, we've discussed the capital raisings. That chart looks pretty positive, and I think a lot of the companies presenting today would be very, very pleased to see that we've got an uptrend going on capital raisings, and the market's very much open to look at your requirements. And similarly with the new floats, this is a chart just showing that the new floats are also increasing. So finally, the 2018 resources outlook. We're nearly halfway through the year, and certainly it's been a good positive start to the sector, to the year. We think there's going to be strong support for the sector, at least for the next couple of years. The stage is very well set. We've got some really good development projects coming in. We've got cashed up companies. We've got an attentive investment market for the sector at the moment. The US recovery should continue to have a positive impact with the tax cuts and infrastructure continuing to support the commodities market. The A dollar continuing to weaken, in our view, will support the ASX sector in particular, so we'll see hopefully increased AU dollar prices, which will support that market as well. Stocks, I think, will continue to be driven by the EV market, but I think there's also a renewed focus on conventional metals, such as the precious metals and the base metals side. So I think we will see renewed investment and some switching out of the higher priced EV stocks to diversify portfolios. Definitely funding is becoming available, and across the sectors I cover and the team covers in general, I'm seeing exploration spend being increased across the board, so that's really going to flow through hopefully to increased discoveries, which will then flow through to increased development and increased excitement within the sector. And I think this says it all. I think we're in for a period of sunshine and roses. Thank you.
Very much for a very bullish outlook there. Do we have any questions for Kathy? We've got a bit of time for questions. Anyone have any? You got a question in the back there?
Yeah, it was a great talk, but with this change of money raises that are coming on, are you seeing a change in the source of the capital coming into the junior markets?
Well, I think the private equity funders are really increasing, and also, yes, I think there's also quite a few companies are starting to look to potentially self-fund rather than to go heavily into the debt markets at the moment.
Are you seeing more interest from generalist investors looking again at the mining space?
Yes, Leo, I think that's the theme we're really seeing at the moment, is that the generalists are not only looking at the resources sector, but typically they'd only look at the larger names such as the Regis and the Oz Minerals, but they're quite happy to be focusing down on the smaller names. For example, Kingston, which is capitalised at sub 50 million, but has a project which could be 200,000 ounces plus. So they're prepared to take a longer term stance on the sector, provided that they can see the potential of a project.
Any further questions? And a question at the front here.
In terms of the base metals, could you distinguish between which metals you're most bullish and bearish on between the short term and the long term? I noticed you had zinc and copper on there, but I wasn't sure if that was more short term or long term oriented, maybe from a demand and supply perspective.
Zinc we're bullish on mainly in the short term because we see a real supply dearth in the short term, but longer term we can't see the demand to continue with the zinc market. Whereas copper and nickel are very much used in the EV market, and nickel in particular versus copper, well, both of them, we're really not seeing a lot of development projects underway at the moment. I think that's the key theme. I mean, there's a lot of very large porphyry coppers such as Wafi-Golpu with Newcrest and Freda with Highlands, but they're 5 to 10 billion type capital requirements for those projects. So we're just not seeing those development decisions being made at the moment. Oh, there's some more supply forecast to be coming in sort of in the medium term with zinc. So I think other than that, it still looks quite positive. But short term, the majors aren't bringing more supply in. So it's really longer term when we're seeing some more supply start to kick in.
Any other questions? Anything else? Well, if there's no other questions, if you would like to talk to Patterson's more, talk to Kathy more, they've got a stand up at the back there. So please do go and have a chat with them about any things you might have on your mind. But for now, thank you very much, Kathy, for a very interesting presentation.
Thanks, Leo. Thank you.